People often imagine the early Atlantic world as a place of opportunity, where colonies flourished simply through ingenuity, hard work, or luck. Yet this story conceals a profound contradiction. The colonies produced immense wealth, yet remained dependent and impoverished. Empires claimed to protect their territories while systematically extracting their resources. The mystery is not whether wealth existed, but where it actually traveled, quietly, bypassing those who produced it. At the center of this hidden history lies mercantilism, the economic philosophy that treated gold and silver as finite and power as absolute. Under this system, colonies were not partners, but instruments, designed to enrich distant capitals rather than local communities. Wealth flowed along invisible channels, orchestrated by state power and financial systems few ever understood. The 17th century marked the rise of an interconnected Atlantic economy, but it was no free market. European empires, Britain, Spain, the Netherlands, and France structured trade networks deliberately, guiding resources, credit, and labor into channels that favored metropolitan interests. What appeared as commerce was, in fact, a carefully controlled mechanism of accumulation. Colonial trade networks connected 3 continents in intricate ways. The Americas supplied silver, gold, sugar, tobacco, and other raw commodities. Europe provided manufactured goods, textiles, and credit. Africa was forcibly integrated, supplying enslaved labor that made large-scale plantations viable. These connections were not accidental. They were enforced by law, military power, and monopoly. Mercantilism framed the ideology behind this extraction. Accumulating bullion became synonymous with national strength. Colonies were designed to export raw goods cheaply and import finished goods at high prices, producing a permanent imbalance that ensured European capitals prospered while colonial economies remained tethered. Chartered companies operationalized this imbalance. The Dutch West India Company, the English East India Company, and the Royal African Company, among others, were granted monopolies, military backing, and legal authority. They blurred the line between business and governance, creating an architecture where trade served imperial priorities rather than local needs. Shipping routes were mapped not only for efficiency, but for control. Specific ports were authorized, while others were prohibited. Colonial merchants often faced legal restrictions that prevented them from trading freely, even when foreign buyers offered better prices. These rules ensured profits were concentrated in London, Amsterdam, or Madrid. Gold and silver flows illustrate the hidden machinery most clearly. Spanish mines in Potosi, Zacatecas, and Peru produced extraordinary quantities of bullion, yet this wealth rarely circulated locally. Instead, it traveled along controlled shipping routes to serve as European debts, fund wars, and stabilize royal finances, leaving the colonies rich in resources but poor in autonomy. Plantation economies reinforced dependency. Sugar, tobacco, and cotton generated enormous revenue, but required substantial credit, insurance, and shipping, all controlled by European financiers. Colonists remained perpetually indebted. Even during boom periods, the system ensured that the rewards of production flowed upward, not outward. Early legal frameworks codified this dependence. Laws dictated what could be grown, sold, and transported, and in many cases prohibited diversification or free trade. Protective in appearance, these regulations systematically weakened colonial economic autonomy, embedding dependency into the structure of daily life. Financial instruments evolved alongside trade. Bills of exchange, early banking systems, and maritime insurance reduced risk for European investors while transferring it onto colonial producers. Losses were localized. Profits were centralized. The invisible hand of empire was backed by formalized legal mechanisms that quietly ensured wealth accumulation in capitals. Expansion created the illusion of prosperity. Ports flourished, fleets multiplied, and trade volumes surged. Yet beneath the surface, the flow of wealth followed predictable patterns. The more trade expanded, the more colonies became locked into dependence on European markets and imperial credit systems. Strain emerged as inevitable shocks disrupted the system. Wars interrupted shipping, piracy increased insurance costs, and fluctuations in European demand triggered sudden downturns. These crises exposed the fragility of colonial economies and the structural vulnerability embedded by imperial design. Taxation intensified during these periods. Duties, fees, and excise taxes were raised to fund military campaigns or stabilize national finances. Rather than weakening control, these policies reinforced dependency, compelling colonies to deliver wealth, even when they were least able to pay. Monopolies hardened in response to instability. Far from loosening restrictions, empires tightened control, restricting colonial trade to protect metropolitan interests. Merchants found themselves squeezed between collapsing local markets and rising costs imposed by distant authorities. Failures were frequently blamed on colonial mismanagement. Plantation collapses, crop failures, or stagnating ports were framed as inefficiency, obscuring the systemic origins of the crises. Meanwhile, imperial centers absorbed wealth and risk, consolidating power while leaving the colonies exposed. Consolidation followed naturally. Fewer companies dominated larger shares of trade, concentrating financial power in imperial capitals, where banks and investors could absorb shocks that devastated colonial producers. This system stabilized empires, while hollowing out colonial economies. Boom and bust cycles became routine. Resource prices rose, investments surged, production expanded, then shifts in demand or credit tightened. Each collapse transferred wealth upward, leaving colonies poorer while reinforcing the financial dominance of metropolitan centers. Trade systems normalized inequality by design. Profit became legally separated from production, risk from reward, and power from accountability. These structural lessons laid the groundwork for later industrial capitalism and modern global finance. The long-term consequences persisted. Extraction, dependency, and structural inequality embedded during the 17th century shaped economic relationships long after formal colonial rule ended. Resource-rich regions remained vulnerable, while European capitals thrived on managing flows rather than producing goods. Modern global inequality traces its roots to these mechanisms. Wealth did not accumulate solely through innovation or effort. Was systematically engineered through rules that favored those who designed them. Colonial labor produced value that rarely enriched local communities. Even today, echoes of the mercantilist system remain. Countries rich in resources often struggle with debt, limited industrialization, and market dependency, while financial centers prosper by managing flows and controlling access rather than producing commodities. What makes this history unsettling is its quiet operation. There were no dramatic seizures or thefts. Wealth moved steadily, legally, and invisibly, structured to appear neutral while consolidating power in distant capitals. The machinery was subtle but relentless. Understanding this past challenges assumptions about natural economic development. Growth for some was inseparable from constraint for others. Markets were shaped before they appeared to function freely, and wealth accumulation was rarely spontaneous or accidental. The first takeaway is that economic power is constructed, not incidental. Institutions, rules, and incentives determine who benefits and who bears the cost, long before anyone thinks in terms of free markets. The second takeaway is that dependency is often engineered. When regions are locked into specific roles, their struggles are predictable. Systemic outcomes rather than failures of innovation or labor. The third takeaway is that inequality becomes self-reinforcing once embedded. Structural advantages persist across generations, influencing outcomes long after political or administrative systems change. The warning is profound yet subtle. Systems designed to concentrate wealth and power outlast the states that create them. Policies, trade rules, and financial mechanisms engineered centuries ago continue to shape global outcomes today. Mercantilism's silent machinery did more than extract wealth. It directed global power, built financial empires, and normalized inequality on a scale few contemporaries fully grasped. Understanding its operation is essential to understanding both past and present economic structures. If this history reshapes how you see the origins of European expansion and modern financial power, the next question becomes, what other invisible systems operate quietly today, shaping outcomes we accept as inevitable? History does not conclude with answers. It concludes with awareness, and once awareness is gained, it changes how we see the systems, markets, and societies we continue to inhabit.